It gives us an opportunity after a day of research and other perspectives to hear from the community bankers themselves. And we have a very special treat today, as our panel discussion will be hosted by Brian Sullivan from the Office of Communications at the FDIC and the host of the FDIC podcast. So Brian, I'm going to turn it over to you.
Well, thank you very much. Welcome to a very special edition of the FDIC podcast, webcasting live to the Community Banking in the 21st Century Research and Policy Conference. As John said, I'm Brian Sullivan with the Federal Deposit Insurance Corporation. And today we're going to break out our crystal balls and look to the future of commercial real estate. You know, the last year and a half has turned so much of our lives upside down. And while the banking sector has generally proven to be quite resilient in the face of so much uncertainty, there are still unanswered questions about the possible lasting impacts of this pandemic on our community banks. Well, joining us today to talk about what they're seeing in commercial real estate are four people on the front lines of this sector. For a national perspective, Bob DeChara joins me in studio. Bob manages the FDIC's Regional Research Division in New York City. And we have a number of community bankers from around the country who will give us a sense of how commercial real estate is trending where they are. John Buren is President and Chief Executive Officer of Flushing Bank in Uniondale, New York. Jim Edwards joins us from Griffin, Georgia, where he serves as Chief Executive of Union Bank. And by the way, he is also the current sitting chairman of the American Bankers Association. And out on the West Coast, Joanne Kim is the president and CEO of Commonwealth Business Bank, a minority depository institution based in Los Angeles. Well, hello to you all. Thank you so much for joining with us. And Bob, golly, you're sitting next to me. Let's begin with you. Set the table for us. Where is commercial real estate today, and where might it be headed?
Well, thank you very much, Brian. I'm happy to be with you here today. So you're right. It's been quite a year and a half on many fronts, and particularly for commercial real estate. We like to look at commercial real estate through the lens of the 5 property types, right? It's not a monolithic industry. There's many different facets to it, but these 5 broad areas were impacted very differently. So we have multifamily, which is known, as apartments. We have industrial, retail, hotel, and office. Now, the first two, multifamily and industrial, have been pretty resilient. Particularly industrial. Industrial really is a function of how much we're shopping online, shipping needs, storage, and logistics. And as you can imagine, there's been quite a demand for that as we shopped online much more during the pandemic than we ever have before. The next two, retail and hotel, were challenged severely early in the pandemic. I mean, you think about hotels, the normal occupancy rate nationally hovers around 70% in normal times. That dropped to less than 25%. And at the luxury property, which typically will cater to the business traveler during the week, those occupancy rates dropped to single digits.
Wow.
So it was a tough go of it for many of the hotels. A lot of those occupancy rates have come back, particularly in the the mid-scale properties. We're seeing a little bit of a lag in the luxury properties, as I mentioned. I think that's a function of, the slow return back to business travel, and that may take some time. And retail, it's most of the stress really that's been durable has been sort of in the mall space. There are certainly vacancies throughout some of the strip malls and other areas like that, but there's divergence between real urban areas that require public transportation and so forth, versus maybe some of the suburban areas that are doing a little bit better. And then the last area, office, arguably is the one area that probably has the most uncertainty ahead when we look forward to, possibly changes in how we work and where we work.
Let's focus on that for just a little bit. It's great to define all these property types, but on the office space sector, it seems like what we've just been through this past year and a half is redefining what the office even means and what it means to go to work. I would wager to say that a fair number of us have been working from home. And so what does this mean for that particular sector?
Yeah, certainly. So I would say with the office sector, there's in my opinion, likely a transformational aspect of this pandemic, right? There's certain companies that have said we're going full back. I mean, it's a real range. Some are going full back. Some have said we're permanently remote. And then there's those in the middle that are the hybrid. They may want people to move, different places for remote work, maybe not in city locations and close urban centers that require, public transportation. So there's a lot at play here, and I think a lot of uncertainty. But there are, suggestions and predictions out there by others that we look at the data that suggest that vacancy rates are expected to rise in office. They're typically in the office sector, vacancy rates are usually higher than the other property types when you think about, leasing up large, chunks of property. It takes a little bit of time, but it's expected to extend its lead in vacancy on the other property types, go even higher. So nationally, the pre-pandemic, the vacancy rate was about 10% when you compile all the markets nationally. It went up to about 12 now. It's expected to be about 14 in another year or so. So there's some rising vacancies ahead. And I would argue, many companies may not have to make a decision right away. It takes time for office leases, which are typically, 5 to 10 years.
Yep.
So they may have people working remotely now, but they're still paying the rent, and they don't have to decide for another 2 years what that's going to be.
So adjustments might happen in the years to come.
Yeah, I think we have some time for this to play out.
Okay, well, let's go around the country now and survey our bankers. John Buren of Flushing Bank in Uniondale, New York. John, by some measures, you do business in the number one commercial real estate market in the country. What are you seeing where you are, and maybe what do you expect to see?
So a lot of them Bob had mentioned. I think there's clearly the weak link at this point in time continues to be office, which and I'll even make a distinction there, though. I think that there's a differential between midtown office space that requires public transportation and more suburban locations where people can get to work without without public transportation or limited public transportation. So I think that that's clearly a factor, and it kind of builds upon this whole idea that was just spoken about with respect to commercial real estate not being a monolith. And I think you go from place to place, certainly in office space, and even in the hotel sector, one that did have some substantial pullback as we entered the pandemic. Now we're seeing more local hotels that cater to either local business people or also people coming in for special events like weddings. Obviously, a lot of pent-up demand for people to do weddings in a that would delay, let's say, during the pandemic. So we're seeing those smaller hotels that are not in the center of urban areas or high demand tourist areas actually doing quite well. A lot of it, of course, has to do also with the type of the type of borrowers and type of help that they had during the pandemic. I think that providing that excess liquidity will carry these entities through the next few months or so as things continue to return. That said, I think the retail space is the next one. I think that had some significant softness to it. But then again, along the theme of it not being a monolith, when you look at these small strip centers in suburban markets or even in some of the urban markets, the neighborhoods where the retail is central to the day-to-day lives of the area residents. You have people in walking communities that have to go to the food store, they have to go to the nail place, they have to go to the pizza parlor, et cetera, et cetera. So these types of retail, this retail was among the quickest to come back. So I'm expecting that to continue going forward. And in some way, when you think about this long term, those types of retail facilities are really among the most resilient to the Amazons of the world. So I think that there's a good deal of continued opportunity in that sector going forward.
Okay, well, very good. Thank you for that. Now from the New York metro area, let's head south to Griffin, Georgia, about an hour outside of Atlanta, where Jim Edwards of Union Bank joins us. Jim, are you experiencing anything like what John just described down your way? And do you feel comfortable maybe forecasting what might lay ahead in commercial real estate down by you?
Sure, I'd be glad to offer my comments, and Brian, really appreciate the opportunity to join you and Bob and the rest of the bankers here today for this event. And I think it's great that we're doing this on a podcast. I learn a lot every week from podcasts, and so I did not know the FDIC had a podcast. So since I've gotten to know you, I have gone back and listened to several of those and really enjoyed those. And so I appreciate what the FDIC and you do with that. But so we're a little bit different bank, obviously, in Griffin, Georgia. We're located about an hour south of the world's busiest airport in Atlanta, Georgia. But where our bank is chartered in Zebulon, Georgia, just south of my office here, there's still just 2 stoplights in the entire county. So have a nice mix, really, of being able to lend money in the Atlanta suburbs, as well as some of the more rural areas as we stretch to the southern part of the state. But very fortunate to be in Georgia. Georgia's been one of the fastest growing states for quite some time now. So that's causing a lot of loan growth opportunities for us here. But just quickly about our bank, we're a 110-year-old true community bank, a little over $2 billion in assets now, closely held, operate as a sub-S bank, and also have a large mortgage and trust, and just started an SBA unit as well. So what we're seeing in our part of the world, it's really impressive in terms of the turnaround that we've seen since the beginning of the pandemic, where we sort of, to use the phrase, we didn't know where the bottom of the pool was there for a couple of months. A lot of our customers did not either. But we have really seen, from a real estate standpoint, those markets come back very nicely. Our biggest challenges right now, frankly, are for our builders in this market. It's talking about supply chain issues right now, as opposed to lack of demand, which we were so worried about there at the early stages of the pandemic. But I totally agree with John. You can't look at commercial lending and the future of commercial lending is one monolith here. You have to break it apart. And obviously, we all know how critical location is to real estate. And so that's very important to consider as well. But talking about some of the specific areas there, I think we are seeing some of the lowest levels of past dues now that we have seen really in my entire career. Problem assets are way down. As I said, when we talk to customers about issues, it's not about problem loans right now. It's about how do they find it's supply chain issues when they're trying to do their next build their next project here, really.
Right.
But specifically, we were very concerned about the hospitality and hotel industry early on. That's where we saw the most stress early on, obviously. And I would say that that's come back nicely. There are still some lingering challenges there, as I think John mentioned as well. We're seeing that in the metro Atlanta area also. But overall, not seeing a lot of problems there. Retail, similarly, I think we're seeing, for the most part, our retail commercial loan customers do just fine right now. They did come in. We had a number of them came in and asked for deferments early on, but everybody's back and they're amortizing their loans as originally agreed right now. So that's working out very well. We don't do a lot of multifamily, but that market is strong in our area. Again, with housing prices increasing dramatically here, as I'm sure they are in the other bankers area, we're seeing strong demand for multifamily stock just because of the more affordable nature of that product offering there. And single family construction for one to four family homes is really strong, maybe the strongest I've ever seen it. I don't feel like it's gotten overheated so far. Obviously, we all know, we talked in some planning meetings that we reminded everybody, that Georgia hopefully learned some pretty important lessons here in the Great Recession about getting overextended in the single family housing market. And so I think we, as well as other bankers in our area, are trying to be very cautious about that. But if I had a concern, I would be worried a little bit about the fact that there's so much money that is still sloshing around the system here. But I'm not sure we really know that we can trust our traditional banker instruments, if you will, just yet. So I think we've got to let a little more time go by to see sort of how things shake out here. But In our part of the world, we're excited about the market that we're seeing, and we're so grateful that so many of our customers have seemed to have survived this pandemic scare very well.
Well, it is true. Time heals all wounds, but okay, now we've touched base in the Northeast and a bit down south. Let's head out west now to Los Angeles, where Joanne Kim joins us. Joanne, I wonder, along with all the potential impacts of this pandemic that we've been talking about, you also have to deal with a chronic affordability problem out your way. Land values, development costs very high in Southern California, statewide, in fact. How is all this affecting commercial real estate in Southern California?
Sure. Thank you, Brian. Before I actually talk about commercial real estate, I wanted to briefly talk about Commonwealth Business first so that the listeners will know where I come from. We are about $1.8 billion business bank serving various ethnic business communities here. And commercial real estate is our key product and our bread and butter. About 80% of our loans are in commercial real estate, whether it's owner-user or investment properties. So it is very, very important. And right before the pandemic hits, we are actually in our area, we are talking about some downturn of real estate because real estate business is a cyclical business. And every 10 to 12 years, you will see some downturns. And we are talking about preparing ourselves, what we should do if that happens and stuff like that. And then the pandemic hits. So with all that, this was a very, very interesting time for all of us all of bankers in our area. Of all these 5 different products that we just briefly talked about, we are pretty heavy in the retail area, hospitality industries through SBA lending, and some industrial and warehousing spaces. We are not that heavy in apartments because we prefer not to offer somewhat a longer term fixed interest rate for those apartment buildings. And office market, we actually provide financing for those small office spaces, maybe 10,000 to 20,000 low-rise buildings. That's actually our main business area in the commercial real estate. As far as what's happening in the marketplace, as you all know, it's very hot. It's very hot, especially in our area. There are so many multi-housing or apartment buildings, usually mixed with commercial space downstairs or first 2 stories, and then multi-unit apartment construction projects. So property value, any developable properties, whether they are single family or small space or commercial, the large developers are buying up those properties and convert those into a high-rise mixed-use residential and commercial properties. That market is so strong and it's still going on. And actually, that development project helps the other areas, such as retail properties, because that apartment project, development project brings in people into our community. So there are more jobs, there are more populations, so that require more retail spaces and all that. So surprisingly, the retail sector is doing well. The warehouse, the apartments, even hospitality, they are doing well. We provide financing to limited service hotels. And when we actually collect 2020 financial data in mid of this year, surprisingly, they show 40 to 60% occupancy even in 2020. So that really surprised us, and majority of our commercial real estate borrowers are doing very well. as far as I know that I will talk about the affordability just a little bit. Price has gone up so much. Let me give you an example. About 10 some odd years ago, I financed a property. It's a commercial property, originally an office building, AT&T building in our area, converted to a grocery market. But it has some lots, big lots. And I remember my financing amount was less than $5 million. That property was sold to about $45 million about 2018, I think. No, I'm sorry, not 2018, 2017, 16, around that time. So when I heard that, I said, are you kidding me?
Right.
It was sold for $45 million.
Well, I don't know. I don't know if that's irrational exuberance or what have you, but wow. What a
I know it's a wow, and I did not believe it until the broker who actually transact in that case deposit her commission check. But as I said, okay, I believe in that.
wow.
It's amazing, but not that project. Construction is ongoing now. They are building high-rise, mixed-use apartment and retail, and I believe that they're going to complete that project in the next year or so. So it's happening all over. So it really pushed up the property values, and also it pushed out the small to mid-sized investors. Only the larger players in the development area, they have multiple opportunities. But again, as I said, it kind of pushed out a smaller to mid-sized investor developers in our area. It is very hot. It's I'm glad it's not down.
Yeah. Well, very good. Now that we've surveyed our bankers and got a general sense of about what's happening where they are, let's open it up among us all, if you will. Bob, I'll begin with you though, but please feel free, any of you, to jump in on this. As we got going, I was thinking, are we seeing something transitory here with the impact of this pandemic, or is there some seismic shift taking place? Bob, what are your impressions?
Yeah, sure. I mean, we think about that question also through the lens of the property types. And the one that sticks out to me is, when you say, is it durable, is it transformative or transient? It matters. Is this does this affect how people want to live, work, or behave in some way? And the one that keeps sticking out to me constantly is the work. Where do people want to do the work? And I think there's a lot of revisiting to that going on, whether you're on, all the way on one side or the other. I think it's undeniable where work is conducted is going to change.
I think we all want to be back to where we used to be, right? Generally speaking, I think we can all agree there. We want to go to the restaurants we used to go to. We want to go to the movies. But it's the work thing. Is that still the big sticky wicket here?
To me, that seems to be the case. And I think Joanne's probably a good person to ask this question. And maybe the opposite story might be in retail, where even before the pandemic, retail was going under sort of a transformation. So I'd like to ask Joanne, because I know you're in this space quite a bit. When you talk about mixed use and retail, would you say it's the experiential retail where you actually have to physically go to the property to experience something like a restaurant or have something dry cleaned, or, we talked about nail salons earlier. Are those the types of retail that will probably be more long lasting, and perhaps the places where you have to go buy something where possibly an online retailer could do better, they might suffer a little bit more?
Sure. And I believe the work behavior change might impact mostly in the office and the retail area. In the retail area, I think there's a distinction between large malls versus small neighborhood community shopping center. There's two different things. And I will be focusing on smaller shopping centers that I see in our area. Surprisingly, they are filled. The businesses are opening and open to public, and then people are now walking around and having, they eat in the restaurants and all that. So it's kind of it's almost business as usual to pre-pandemic level. So I am very happy to see that. As far as the larger malls are concerned, I see a lot of vacancies, close out sale signs, and dark storefronts. It's very sad to see it, and I think that larger malls will need to go through a more transformational innovation, renovation, whatever you call it, so that. And then I also hear that they're going to convert that to a gym or a family-oriented entertainment center, movie theater, and all that thing. So, so as far as the smaller retail malls and smaller or mid-sized offices are concerned, people are back to their office. I think the rate of return to the office is greater compared to high-rise downtown area.
Yeah, right.
So, yeah, so I see a lot of positive signs.
Jim, John?
So just as just as we were anticipating the demise of Manhattan office space, in walks Google and pays $2.1 billion for a New York office building. So I think that there is this kind of push-pull, and I think all of us have experienced it in our industry as well. There's great power in being able to work remotely, but there are things that you do miss by not having that camaraderie and that glue that takes place in an office environment. And clearly, no less an icon of remote capabilities. Google decides that they're going to invest $2 billion in office space. So I think that we'll see this scenario evolve, or this structure of work evolve over time, and I don't think we've seen the end of office space, but I think it's in for certainly choppy, a choppy time frame, given the uncertainties and the degree to which people do not want to return, especially along the lines of public transportation. I do agree with Joanne wholeheartedly again about the retail space. I think there's certain types of retail that is internet proof, if you will, where there may be a high degree of touch involved, a high degree of service involved, and those are the things that are going to underpin strong retail growth. I think big box retailers, I think they're going to be problematic. I think malls, as Joanne mentioned, again problematic. But people need to do certain activities or make certain purchases in a much more intimate type of relationship than online.
Right. Jim, how about you?
Brian, I'd agree with what John said there. I mean, I think we're all trying to figure this out. We're even trying to figure this out in our work environment for our respective banks, I'm sure. I know we are here at United Bank, but I think office, your workplace in the office is the composition of that is going to change. It is changing. And what we're seeing is, I think one trend is you're seeing less square footage needed per employee. And so while I don't think commercial office space is certainly going to evaporate for all the reasons we've talked about, there are a number of things that you need to do, that you need to be face to face with people for. But I do think we are seeing more of a trend that employees are not required to be in the office every single day. And that is having a spillover effect in our part of the world, being an hour outside of Atlanta. You roll back 3 or 4 years, there was a trend where we were not losing population, but we had some customers that were saying, I just can't deal with the traffic and driving to Atlanta an hour and a half each way, and doing that 5 days a week. And what we've seen since the pandemic, though, is sort of a reversal, where we're seeing employees going, gosh, I'd rather be a little further outside of the city. I can buy a bigger house, I can have a nice yard, maybe they're ready to have a family, whatever, but they're moving into our area and they're saying, I still will be going into Atlanta a couple days a week, but I can do that. But I'm not going to have to go in. My boss has told me I'm not going to have to go in 5 days a week for the foreseeable future here and really long term. So
Right.
I think what we're doing right now, having this type of meeting over a teleconference, video conferencing system, that's not going away. Soon.
Right. Well,
But may I jump
yeah,
in
please,
about
Joanne.
the work from home arrangement? I think there's a kind of a new trend coming in about they are rethinking about work from home arrangement, because I think we are people person. We love to get together and then share our thoughts in person. So I think after about more than a year of working at home and all those different environments, people now wants to come back.
Right.
They wants to come back and have a social interaction and have a person-to-person conversations. And also many employers, small to mid-sized business, they see that their efficiencies and productivities are not par. And they see this coming down, and they're having problems with to create collaborative work environment, building a teamwork and stuff like that. So I see more and more small to mid-sized business people. They are bringing their people in, and employees are happy to come back. Maybe we may need to arrange some kind of a hybrid work
Right.
from home plus work at the office. But I don't think it's going to be totally kind of a work from home arrangement. At least that's what I see.
Well, I think we anticipated a question we got from one of our audience members. Prior to the pandemic, the talk around the office was densification. The smaller office spaces for the same amount of employees, and I'm hearing that might be a movement away from everybody wanting that big, corner office maybe, and figuring out another way to maybe go in less often, but some hybrid arrangement, as you just mentioned, Joanne. But I do want to pivot just a bit. One of the things the pandemic has really seemed to reinforce for everybody is that Dorothy was right after all. There is no place like home. And in many parts of the country, we're seeing just a huge demand for housing and low supply. And I should think that all of this suggests there's room for growth in construction lending and on the multifamily side in particular. Let's just turn to you, John Buren, just outside of New York. You have a lot of experience in the multifamily residential space, right? So what are you seeing?
Yes. We have probably about over $2 billion of multifamily real estate, it's not multifamily real estate is not a simple story in New York either. So you have in New York an affordable segment of the multifamily business, which is rent stabilized, or in some cases rent controlled, but mostly rent stabilized. So that rent stabilization, the rents are very much governed by the state, and those rents take place. Those rents are changed, and the ability to raise those rents have changed regularly. And you contrast that with the multifamily market rate run multifamily. So I'll kind of go through the pandemic in a couple of seconds here. The pandemic hits. Everybody in market rate multifamily who could leave and find another spot, go home with parents, go out to the Hamptons, etc. Those people, they left the city. The multifamily people who are in affordable housing, they obviously had no place to go. They stayed, and rents continued to get paid pretty much. After a brief hiatus, rents were pretty much back to significantly complete rental payments. So now all of a sudden the pandemic starts to wane. And of course, what happens is everybody starts moving back. I mean, market rate, young people are moving back into the city. Maybe not at quite the level of density, but just prior to the pandemic, New York had gone through a pretty significant increase in multifamily construction activity. And I'm not seeing much weakening in that market.
Okay.
I mean, clearly it's weaker than the rent regulated market, but I'm not seeing a disaster even in the market rate environment. So I think the eventual absorption and the desire to work in New York City still has a great deal of appeal to young people, and I think that is going to certainly support even market rate multifamily going forward.
Okay. Well, Jim Edwards down in Georgia, your bank's footprint is largely in a suburban and rural setting. What's the impact to the single family residential construction market?
Yeah, and I touched on this briefly in my earlier comment there, but it is quite strong, Brian. It might be as strong as I've ever seen it. Just with, I think one of the challenges right now, though, is that we're sort of running out of developed lots in our area, and for a long time we had such an oversupply of them coming out of the recession that many of those lots were still available, as recently here as a couple of years ago, but those have run out pretty quickly here. And so we're seeing extremely strong demand. I will say, though, that I think one of the things that's different is we're seeing, in my opinion, much better qualified buyers across the board here. Folks are sticking to their underwriting guns from a development standpoint. In terms of developers have real money in these projects. Certainly not, that was not as much the case back in the run up to the Great Recession. So I think that bankers are being careful about that and are making sure that they're being conservative with that, because they realize how quickly things can turn in that sort of acquisition and development market there. But it's just the Georgia or the Metro Atlanta area has a very strong economy right now, and that is causing strong demand growth and jobs in the area, and with that comes significant housing demand. And so, we're working hard to try to fill that need there, and people seem to be really responding to that. We've not seen quite the price appreciation that you heard Joanne talk about, but it's very strong.
Yeah.
And so we'll see how if this lasts, but I do think we see continued good inbound growth into these markets that we're in right now.
Okay. Joanne, turning to you, you had brought this up earlier a little bit about this intersection with all these various property types, because really we can talk about office and we can talk about retail in isolation, but they all sort of touch on each other a little bit. I'd love to hear your observations, to expand on a point you made earlier. Just in office space, for example, we were talking about fewer people going into the office. What about all those businesses, the small and medium-sized businesses that you deal with out there, who might depend upon people going into work? If they're not going into work, I imagine it affects them too.
Sure. Actually, in the downtown area, I think a lot of those ancillary services, such as, you say valet service, the small snack shops, and even shoe shine places. And those small businesses, I'm very sad to see that they are gone. They don't offer any valet services, and then the small stores were closed. I don't know whether it's permanently or temporarily. So it's pretty sad in quite a few buildings in downtown area. So definitely having lesser people coming to work affect negatively to those small business people in that area. As far as the low rise in our own community, many of those businesses have come back strongly. And their issue now is finding people to work.
Right, the labor market.
The labor shortage and wage hike is a major issue. We have a lot of small and large restaurants in this area. they close some of the mid-sized restaurant. They close section of their space because they cannot find people to work for that restaurant. So it's a different story. But the retail businesses, retail service businesses are coming back. They appear to be strong, and people are going out and then eat. But we have to wait a little bit longer for the services. But business, it's two different things. The downtown business versus our community. The small community businesses are stronger and more resilient because there are still people walking around and around the area, working at the office.
Bob, let me turn to you. I don't know if you have any data about how this labor market and that's a pain point, right? And as you think about labor, let me throw another little wrinkle into this. We got a question from one of our audience members about whether banks are giving any thought about the risks in their CRE portfolios related to climate change. I know that there was a survey question asked at this conference at the beginning on climate change, and there didn't seem to be much of a thinking that maybe in the near term, at least, that there would be much of an impact. But on these external variables, labor, climate change, what have you, is there any data you can point to?
Yeah, I mean, certainly labor has impact, across all these property types, right? And I know in the Northeast, which is a major coverage area for me, we've seen some of our states lag the national recovery. The U.S. has gained back, a little over 60% of its jobs that were lost. We're still down a bit. That's lower in some of our New England and northeastern states, particularly in the urban areas. And we've seen at the, maybe the lower income jobs. I know leisure and hospitality, has come back somewhat, but is still one of those lagging sort of job sectors. And that has implications. I know it was mentioned earlier how well the multifamily has held up, with stimulus and all sorts of other ways that renters were helped out. There was a minor blip for a few months when the pandemic first hit with the on-time rent payment performance. But even that has returned to about 95% on-time payment performance. And we look at data from Multifamily Housing Council, which has released some data since the pandemic began. And we saw that drop, into the high 60s and then really immediately kind of return to that 90. It's a little bit below where it was pre-pandemic, the on-time rent payment performance, but there's been a lot to support folks that needed help there too.
Okay, well, we're reaching our time here, and as we wrap things up, I'm just going to go around the horn here and ask each of our community bankers if you're bullish or bearish, just generally speaking, on the commercial real estate sector. And John, let's begin with you.
I'd have to say bullish. I think things are coming back. New York has really only been open since May, so I think that we'll see more and more activity.
Okay, how about you, Jim?
Yeah, so I'm certainly bullish too. I would, at the risk of sounding like I'm talking out of both sides of my mouth, though, I do know that I made this comment the other day to somebody that bad loans get made in good times, and we're in what appear to be very good times right now. And so I think it's important. We're trying at our bank, I know, to be certainly open and to new ideas from our customers and assisting them in what they want to do and be great partners, but also just be careful right now. So, but I think good times are ahead, but all bankers need to be cautious.
Amen to that. Joanne.
I will say cautiously bullish because there are still some unanswered questions, because I know that there is a massive government relief fund, and that actually helped a lot. What will happen if these funds dry out? Can these price, because I mean in our market the price is so high, unreasonably high. Can they sustain that price, or is the price going to come down? What happened to the bankers who finance all that thing? So we are actually, I am a little bit bullish, but I am cautious because I still try to figure out how these things will affect the market. And I think in a way, considering the cyclical cycle of real estate business, I think we are kind of getting closer to the peak and
Mountaintop.
going to the next cycle.
Right.
You never know.
Okay. Well, Bob, I'll give you the last word here. I know that you'll be following the CRE market very closely into the future, but where do all the indicators point?
Yeah, absolutely. So I'll avoid the bull bear answer coming from the regulator, if that's all right. But I will say, you know, that our community banks are very important to this sector. You know, they have only a small share in total of the total assets of FDIC insured institutions. They account for about 10%, community banks as a group, but they account for 30% of the commercial real estate loans. So they're active in the space. They're a group that serves small communities across the country in this space. And it's an asset class. It's important to us. It's important to them. And it's something we're going to watch closely going forward.
Okay. Well, I want to thank Bob, you, of course, for joining us, but also our community bankers around the country, John Buren and Jim Edwards, Joanne Kim. Thank you all for joining us today for a really great sort of across the board look at our commercial real estate market. I do appreciate that. Thank you.